Yes. So I told you try in this case to prepare what the statement of income, and you see in this case eventually how it likely end up having to come out. How it likely end up having to come out. So we can now in this case prepare it and see what will eventually come out. What will eventually come out? What will likely eventually come out? So it is Salama Limited. So hope you have the question. So Salama Limited, statement of profits or loss, statement of profit or loss for the year ended, for year ended 31st of December 2022. 31st of December 2022. So we can have in this case our shillings in thousands. We can have our shillings in thousands like that. Our shillings in thousands. Our shillings in thousands. So let me adjust the camera a bit. So we can start in this case with the revenue. So what you normally start with in this case, you'll start with the revenue. Revenue can be able to get it in the TIO balance there. So you can be able to get it in the TIO balance. It is 283,460. So hope you're able to see it, 283,460. 283,460. Then you less the cost of sales. You'll end up having to less the cost of sales. Remember we said for the cost of sales, in this case, you have to do a computation separately. You have to do a computation separately. You get a figure, then you just place it here. You don't, in this case, come here and start having to say opening stock plus purchases minus closing stock. That's not how, in this case, you present published financial statements. So this particular component here, you do a working separately. And of course, you're able to do a working. What was our figure for cost of sales? We were able to do a working. What was our figure for cost of sales in our workings? 153,400. 153,400. So it is what was 153,400. So you can in this case be able to minus. You can actually be able to minus. So that in this case you can be able to get the gross profit. You can be able to get the gross profit. You can be able to get the gross profit. So 143,650. 143,650. 143,650. So under the gross profit, or on this gross profit, as per the presentation, the requirements in this case, you'll end up having to add other comprehensive income. So other comprehensive incomes, other comprehensive incomes, other comprehensive incomes, other comprehensive incomes. So here under the comprehensive incomes here, what the components here can be investment income, it can be investment income, or maybe in this case, it can be any other income, for example, on sale of what? Sale of fixed assets, sale of fixed assets. So after you've been able to get the gross profit, you'll be able to put here other comprehensive incomes. So the component of other comprehensive incomes here, it is normally majorly investment income, or for example, in this case, if you realized any income when you sold assets, you can be able to put it as what? Other incomes. It comes immediately after the gross profit. It comes immediately after the gross profit. After the gross profit. So in this case, it is the gross profit is 130,060. So yes, 130,060. So I don't know who gave me that figure, 143. 130 060. So 130,060. 130,060. Thank you very much for the correction there. So I don't know who gave me that figure there in the chat. So 130,060. So take note of what I'm having to say about this one, because it is very important. You need to remember it. We're having to say on the gross profit, you'll be able to add other comprehensive incomes. The components of comprehensive incomes can be, for example, if you realized any investment income. So if you realize any form of investment income, you can end up having to put it here under what? Other comprehensive incomes. And therefore, in this case, if you look at the trio balance, we have in this case investment income. Investment income of how much? We have investment income of how much? We have investment income of how much? 1,500. So we'll end up having to add it here, 1,500. So this one you can be able to see it on the credit side of what? Of the trio balance, of the trio balance, of the trio balance. So after that, then in this case, you can be able to recognize the expenses. You can be able to recognize what? The expenses. So one of the expenses we have in this case, we computed it. We have the admin expenses, administration expenses, administration expenses. And of course, in this case, also we have distribution. Is it distribution costs? Distribution costs. Distribution costs. Sometimes it is normally selling and distribution. It is normally selling and what? And distribution. So a distribution cost in this case didn't have any form of adjustment. So it remains the same. It was 22,300. While in this case, admin expenses in our working, it was how much? Admin expenses in our working, it was how much? Administration expenses in our working was 335,000. Is it 456 or is it 416? So is it 456 or 4? Current poll. So 35,456. Confirm that figure, 35,456. So the majority are having to say 35,456. So current poll is saying 35,416. So I think it's 35,456. 35,456. So that was the figure for what? For our admin expenses. Our admin expenses. So in this case, we can be able to minus them. We can actually end up having to minus them. We can actually end up having to minus them. You can end up having to minus them. We can end up having to minus them. End up having to minus them. Then, of course, in this case, we also had what? Finance cost. So in this case, finance cost. So in this case, you have finance cost. Finance cost was actually under working two. Think working two. So if you look at working two, we did a computation for finance cost. It was coming to how much? It is in working. This one is in working two. Working two. So it was coming to how much? The finance cost. So remember, finance cost is basically the interest expense. Interest expense. So we had the interest expense for preference shares and of course for debentures. It was 1260. It was 1260. It was actually 1260. So with this, then you can actually be able to get the profit before tax. So you can get the profit before tax. So profit before tax. Profit before tax. You can get the profit before tax. Just compute the figure. You do the mathematics. 130 plus this, minus this, minus this, minus this. You should be able to get the profit before tax. You should be able to get the profit before tax. So the comprehensive income, this is 𝗖𝗂𝗂𝗍𝗂𝗍𝗂𝗍𝗂. It is from the trio balance. It is from the TB, which is what? Investment income. It is from the trio balance. It is 72. 𝗖𝗂𝗂𝗍𝗂𝗍𝗂𝗍𝗂 check the trio balance on the credit side. You'll be able to see this investment income of 1,500. So it is 72,544. 72,544. So like that. So that is the profit before tax. So but in this case, we've been told the corporate tax, the tax rate was actually how much? 30%. So in this case, we can actually end up having to do what? Compute the tax, but I think we had already actually in this case done what? Consider the tax when you are looking at the income taxes. When you are looking at the income taxes, we were able in this case to already come up with what? The income tax for this particular year, which will actually end up having to recognize as part of what? The liabilities, which were not actually in this case what? Settled, which were not actually settled. It will be under what? The current liabilities. It will be under the current liabilities because this particular tax was not actually settled. So we had done it under what our working. So we'll basically in this case just get what our profit before tax, because it was just provided for. It was not actually in this case what settled for this particular year. For this particular year. For this particular year. For this particular year. So that was working number 4. Working number 4. I think under working number 4 we had gotten what? I think deferred tax plus so the income tax was coming to how much? It was coming to 20,250. So I think we'll be able to provide it. So this is the profit before tax. So this is the profit before tax. So there's that working for income tax. So we'll in this case consider the income tax here. The income tax. I think it was 2,200 and it was 2,250 years. So that in this case you can be able to get the part or profit after tax. So profit after tax. So you can get the difference to get the profit after tax. You can get the difference to get the profit after tax. Profit after tax to get the profit after tax. So it is 52,294. So 52,294. Yeah. So hope you're able to see there. 52,294. That will be the profit after tax. So this one was, I think, under working number 4. So we had done it under working number 4. So the income tax expense that was charged for the year, it comes to 52,294 as the profit after tax. The profit after tax. Then the next part, in this case, you are supposed to get the statement of changes in equity. Statement of changes in equity. So under statement of changes in equity, we'll just in this case be able to consider how the equity elements were having to change. And when we talk about the equity elements here, so you have the ordinary share capital, we have the ordinary share capital, and what else? We have ordinary share capital, we have the revaluation reserve, and of course you have in this case what? The retained earnings. The retained earnings. We have the ordinary share capital, revaluation reserve, and of course then in this case what? The retained earnings. So remember in this case I told you that in this case the redeemable, you can look at in the tree of balance, we have redeemable preference shares. We have redeemable preference shares. So these redeemable preference shares, what did we say? How do we treat them? We have redeemable preference shares and of course what? Debentures. These ones will be recognized as what? They will be recognized as what? They will be recognized as what? The redeemable preference shares. They'll be in this case be what? Liabilities. We said they'll be non-current liabilities. Same case with this case what? These ones, non-current liabilities. But if it happens they were irredeemable, if they were irredeemable, it means in this case, they'll likely be recognized as what? As a part of equity. If they were irredeemable, they'll be recognized as part of equity. But since they were redeemable, in this case, redeemable, they'll be redeemed after maybe 2 or maybe 3 years. So they'll have like a lifetime. They'll have like a lifetime. They'll come to an end. It's just a liability that is having to be incurred, which will have to be settled in future, maybe after a number of years. But irredeemable, these ones are going to be there for the lifetime of the company. So it means in this case, it can be part of the components of what? Of equity of the company. So I can see Andrew is asking about the income tax. So Andrew, there is a computation we did for income tax working number 4. Kindly confirm, Andrew, if you have that working or if you don't have it. Andrew, confirm whether you have that working. I think it was working number 4. If you don't have it, you say you don't have, so that we explain how we are getting it. You don't have it. Were you in the previous class? Or you are not there? You also tell us whether you are not there so that we know how we can assist you. Were you in the previous class or you are not there? You are not there. So I think Andrew has a challenge, has a challenge. So this is the problem of having to get into a class midway. So these are some of the challenges that are there. But now in this case, maybe we can just be able to briefly explain. Hope you'll be able to understand. If you look at, do you have the question? You need to have the question. If you look at, in this case, the additional information under number 4, you've been told the taxable timing differences were 24 million, while the deductible timing differences were 10.5 million. So we said in this case, to determine the tax expense, we'll be able to consider two components. So deferred tax, we'll consider deferred tax, and we'll end up having to consider in this case what? Current tax. Current tax. So you have to add the two, the deferred tax and of course what? The current tax. So in this case, for the deferred tax, you'd be able to consider whether there was an increase or there was what? A decrease. Whether there was an increase or a decrease by having to compare the figure you have at the start of the year and the figure you have at the end of the year. So for the current tax here, you've been told just there, the next one, the corporate tax was actually 21.4 million. That is under note number 5. So already this one you have it. It is 21.4 million, 21,400,000. This is the tax for the current year, which in this case you've been told is exactly how much? 21,400,000. But for the deferred tax here, we said you need to be able to compute what was the deferred tax by the end of the year. So in this case, you look at the timing differences, whereby you get the positives and of course the negatives. You have to take 30% of, in this case, 24 million. You minus, in this case, how much? 10.5 million. Like that. You take 30%. You get the timing differences. Which will be 24 million minus 10.5 million. So if you do 30% of this, how much are you having to get, Andrew? If you do 30% of this, how much are you having to get? %30 of that, how much are you having to get? You're getting 40, 50. You can see people are saying 40, 50. So hope it is 40, 50, exactly 40, 50. So this is basically the deferred tax by the end of the year. But now in this case, we said you need to be able to look at the TO balance. If you look at the TO balance, there's a deferred tax of how much? 5,200. Hope you can be able to see it. It's the second last item in the TO balance. This one is said it is the deferred tax at the start of the year. It is the deferred tax at what? At the start of the year. Is the deferred tax at what? At the start of the year. And therefore, in this case, it means by the end of the year, there was actually what? A reduction. There was a reduction up to what? How much? 40, 50. 40, 50. So this reduction in the deferred tax is like, in this case, what? An income. Is like an income. So if you get the difference here, I think you should be able to get a figure of, is it 850? Is it 850 or how much? 1250? Is it 1250 or 850? So I don't know. 1150. Is a difference of 1150. I think it is 1150. Is a difference of 1150. So 5,200 minus 4050. You'll be able to get what? 1150. 1150. So because this one is actually a reduction, is like an income. And of course, you said in this case, a reduction in the deferred tax. A reduction in the deferred tax, how do you do it? Do you add it or you minus from the tax expense? A reduction in the deferred tax during the year, do you add it or you minus? You less. So you're having to say in this case, you do what? You less. Because now in this case, it is like what? An income. So therefore, in this case, it means this one will likely end up having to be a negative. So if you take 21,400 minus 1150, then I think you should be able to get this figure we're having to get here. 20,250. 20,250. If it is a reduction, is like an income on the deferred tax, because at the start of the year it was 5,200. At the end of the year it has reduced. It hasn't increased. If it increases, that is an expense you're having to incur, and therefore you would have added here on the tax expense. But this one is like an income. So just take note. Whenever the deferred tax reduces, you deduct it from the tax expense. Whenever the deferred tax increases, is like incurring more expense that has to be settled in future. And therefore, in this case, you add. So if it was in this case having to increase, let's say, for example, you had computed here, and we realized that in this case, maybe it has come to 6,000. This figure here has come to 6,000. We did the computation. We realized it has come to 6,000. When you compare with the start of the year, it is increasing by how much? 800. So it means the opposite would have happened here. An increase in the deferred tax, it means the tax expense is having to increase. So the deferred tax we had at the start of the day is not the same as the one we have at the end of the day, because it has increased. An increase in the deferred tax it means in this case, the opposite actually happens. It ends up having to increase what? The tax expense. And therefore, we would have added. Andrew, what I can be able to advise you, you need to, in this case, go back to the specific videos we've been able to do, especially regarding what? Income taxes. You'll be able to understand far much better. So go back, rewatch those videos on income taxes, rewatch the video we did for the previous class. You'll be able to catch up very fast with what you're having to explain here, because I know, even as what I've been able to explain, it might seem to be, like in this case, confusing a bit for you. But if you watch the videos for income taxes, you'll be able to understand what you're having to say here, because this income taxes is like a whole topic. It's like a whole topic that you must actually be able to understand. When you talk about deferred tax, what do we actually mean? So it's a tax that in this case will be settled by the company in future. But how do you compute it? There's a whole computation as to why in this case you can arrive at this one. So you are far much better off if you watch that particular video on income taxes before, in this case, we try to explain this one. Because I know, even as I've explained here, is like just a shortcut. It's the simplest way to be able to explain, but you must be having a background concept regarding what income taxes that you've already been able to do as what? As a topic. You'll be far much better off to be able to understand this. So this is how basically we've been able to arrive at this particular what? Figure here. We, in this case, computed a tax expense under working number 4, which had a component of deferred tax, then a component of what? Of current tax. The deferred tax, we are considering whether it is increasing or reducing, so that in this case we can be able to know, will it increase the tax expense? There are 2 components of the tax expense, the current tax and of course what? The deferred tax. So like that. That's why in this case we ended up having to get this particular figure here. So we were actually here. So we were trying to, in this case, start looking at what? The statement of changes in equity. So we're having to say, if you look at, in this case, the TO balance, because I know what could have ended up having to confuse you, maybe you would have been able to conclude that in this case, redeemable preference shares, maybe in this case, could have actually been part of what? The equity. Because in this case, in the statement of changes in equity, we consider how the equity elements are having to change. So in your question, basically, you must be able to look at what are the equity elements we have at hand, and how have they actually been affected during what? During the year. So if you look at the TO balance, the first item we have, it is ordinary share capital. That is an equity element. But in this case, I was having to clarify. We're having to be told there were 8% redeemable preference shares. These ones, you need to take note from now, because you'll see them frequently in most of the questions. It will be considered as what? As an uncurrent liability. But if it happened, for example, the examiner had told you they were irredeemable preference shares, then it can be part of what? The equity elements, because this one actually exists for the lifetime of the company. And therefore it will be there forever, like what? Capital. But this one has to be repaid like a loan. It has to be repaid because it will mature, and of course the company will have to pay back these monies to the holders of what? Redeemable preference shares. So it can't be part of equity. It's like a loan. So it's what? A long-term liability. Same case in this case with what? Debentures. Debentures, they have maturity, and therefore they have to do what? To be settled after a particular point in time. So therefore in this case they'll be part of what? The non-current liabilities. So in this case, our equity elements here, which will be able to consider how they're having to change, it is ordinary share capital, revaluation and reserve, and the retained what? Earnings. The retained earnings. That's what we'll be able to end up having to do what? To consider. So therefore in this case, we can look at our statement of changes in equity. We can look at our statement of changes in equity. Statement of changes in equity. Statement of changes in equity. In this case, you have Salama Limited. Statement of changes in equity. Statement of changes in equity. So in this case, we have ordinary share capital. So ordinary share capital. Then we have revaluation reserve. Then we have, in this case, retained earnings. Retained earnings. So because our shillings are actually in thousands, so with this one, you'll have to start with the balances at the start of the year. You'll have to start with the balances at the start of the year. 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 So you have balance brought down. So these ones, you get them from the trio balance. The ones you've been given in the trio balance. So for example, in this case, we have ordinary share capital is 20. Then in this case, ordinary share capital is 20 million. Revolution reserve is actually 3,400,000. Then in this case, we have retained earnings. It is 14,160. So these are the balances for these equity elements at the start of the year. But now, simply it is called changes. We need to see how in this case it was having to change during the year. For example, for the ordinary share capital, you have to consider, were there any new shares that were actually in this case done what? Maybe issued. That could actually end up having to do what? Affect the ordinary share capital. Because in this case, ordinary share capital is all about having to do what? Sell the shares. Revolutionary reserve, were there any assets which were revalued during the year? Maybe in this case, you can be told the value of land ended up having to be revalued up to this particular amount. So it will create what? A revaluation reserve. Retained earnings, this was the balance at the start of the year. But of course, during the year, we've earned somewhat profits. So in this case, you have to include them so that you can be able to know by the end of the year, what are the retained earnings we are carrying forward to the coming year? What are the retained earnings we are carrying forward to what? To the coming year, to the coming year. So that is what in this case will likely end up having to happen there, will end up having to happen there. So we can in this case, for example, look at what could be the items having to affect these what? Equity elements. So for example, if you look at note number 6, in the suspense account, there were two items there, elements there. The proceeds from the sale of the plant, and of course, now in this case, there was number 2, 10 million being a bonus issue of shares, which has actually been considered under the suspense account, which is 26 million as the last item in what? In the trio balance. Then of course, in this case, if you look at the retained earnings, during the year, in this case, we've been able to realize a profit of how much? 52,294. 52,294. 52,294. So I think those are the two key elements. Those are the two key elements there. Those are the two key elements there. Those are the two key elements there. So we can be able to add them. So we have bonus shares. Bonus shares. Bonus shares are simply extra shares which were given to the shareholders. It is under note number 6. So the bonus shares in this case were worth how much? 10 million. Were worth 10 million. So this particular item is only having to affect what? The ordinary share capital. Then in this case, we have retained earnings for the year, or the profit for the year. So profit for the year. Profit for the year, not retained earnings, but profit for the year. The one we've been able to compute now in this case here, we'll end up having to add it on the retained earnings. We'll end up having to add it on the retained earnings, which now in this case, it was an amount of 52,294. Adjust the board so you people cannot be able to see there. I think that's okay. So you have in this case profit for the year 52,294. So 52,294. 52,294. So 52,294. 52,294. Then in this case, from that, in this case, you also have, we have interim dividend on, in this case, what? Interim dividend paid on ordinary share capital. So interim dividends on ordinary share capital, So this one will basically also in this case be settled there from the retained earnings, which is actually how much? 2 million. It is 2 million. It is actually 2 million. I think it is actually 2 million. It is actually 2 million. It is actually 2 million. So interim dividends, they are paid on ordinary share capital. Is actually in this case how much? 2 million. Remember in this case, the preference dividends in this case will likely be accounted for under the finance cost. It will likely be accounted for under the finance cost. So it will likely be accounted for under the finance cost. So therefore, in this case, it won't actually end up having to do what affect the retained earnings here. So we'll be able to deduct in this case the interim dividends on ordinary share capital, which is actually of how much? 2 million. So I think those are the only items having to affect what? The equity elements, So you can be able to get the totals. And remember these particular totals here, that the ones in this case you'll take to the equity part, in the trio bar, in the statement of financial position. So this one is actually 30 million. This one is 30 million. This one is 3.4 million. Then this one, if you do the computation, what are you having to get? 14,160 plus 52,294. So these are basically balances that are having to be carried down. Balances having to be carried down at the end of the year. So this one is at the start of the year. This one is at the end of the year. Balances having to be carried down at the end of the year. So 14,160. So will not, number 7, not affect So the directors propose to pay a final dividend of 1.5 per share on the outstanding shares at the year end. They actually propose to pay what? Dividends at of 1.5 at the end of what? End of the year. So remember, in this case, they just made what? A proposal. So they made what? A proposal, which in this case, they never actually paid this particular what? Dividends. So they never actually paid this particular dividend. The only dividend that was actually paid is the interim dividends. And therefore, in this case, it will affect the retained earnings for the year. Remember, in this case, if they had just actually proposed, then maybe in this case, it means they'll end up having to settle it maybe what? The coming year. So they didn't actually make the payments. Therefore, in this case, it won't actually end up having to affect what? The retained earnings for the year. It is just a proposition. They never settled it. So it won't actually affect the retained earnings for this particular what? Year. So we'll only be able to consider what? The interim dividend. We'll only be able to consider what? The interim dividend. We'll only be able to consider the interim dividend. So what are you having to get in this case as the total here? So 14,160, 52,294 minus 2 million. Interim dividends on, yes, we'll be able to consider it as a liability. So we'll remember in this case, during the year, they paid what? 960. So they paid what? 480. And of course, in this case, you remember when you did the computation for in this case, redeemable preference shares, dividends, it was how much? It was 8%. It was 8% of, in this case, was it 12 million? It was 8% of 12 million. So we are getting how much? 960. So that was the figure. Mrs., you are getting 960. Was that the figure? Just confirm to me, Mrs., so that I explain something here. When we are computing, in this case, the preference dividends, it was 960, sawa. And in this case, they had actually settled what? An interim dividend of 480. So what will happen to, in this case, the other 480? So we'll be able to consider it as what? As a liability, sawa. Because they didn't actually settle it, by the end of the year, we'll be able to consider it as what? As a liability. We'll be able to consider it as what? As a liability. The only amount they settled was 480. That is the figure you're having to see there. Interim dividends paid, ordinary 2 million. Preference 480. So that's what I was having to say. The interim dividends on preference, redeemable preference shares will be accounted for under finance cost. And therefore, in this case, the finance cost for the entire year regarding the preference shares was 960, which we computed, I think, in working number 2. You can be able to see it in working number 2. If you check your book in working number 2, you'll see 960. In the year, they paid interim of 480. Je, ilikuwa imebaki ngapi by the end of the year? Walikuwa na deni ya kulipa ya 480. So this 480, we'll be able to consider it as what? As a liability. So utaiona saa ile tutatengeneza statement of financial position as what? As a liability. That's why in this case you can see we haven't included it here. That's why I'm having to say it is accounted for under the finance cost because the redeemable preference shares is not part of equity. It's not actually part of what? Part of equity. In this case, it won't affect here. It would end up having to affect here. So you can get the difference. What are you getting as the figure? The figure is 64,454. 64, hope it is correct. 64,454. I've just seen the figure there. 64,454. 64,454. So that is basically, in this case, you'll end up having to prepare what? The statement of changes in equity. So in this case, under the statement of changes in equity, you look at how the equity elements are having to change during the year. Most probably in this case, if it is regarding ordinary share capital, you have to consider whether there were any new shares which were issued during the year. You'll end up having to add. In this case, if it's revaluation reserve, you have to consider whether there was any asset revalued. If there's an asset revalued in this case up, you'll end up having to add. If it was revalued down, you'll less. Let's say, for example, in this case, they tell you land was revalued in this case by from 6 million up to, in this case, 9 million during the year. This one will be able to create a revaluation reserve of how much? 3 million, which you would have added here. Or maybe in this case, you can be told the buildings were revalued. Really, in this case, they will be able to revalue them going down. But let's assume they say from 6 million, maybe up to, in this case, 4 million. This one was actually going, there was a downwards, you would have ended up having to do what? Deduct. But rarely in this case, you'll see, they'll tell you revaluation went down. It always goes up. It always goes up. In terms of assets, majorly the asset revalued is normally land. So under normal circumstances, the examiner will tell you land was revalued up, maybe in this case from 10 million to 16 million. So when the land is revalued up, it creates what we call what? A revaluation reserve. It basically goes to be part of what? Your capital in the business. Under an item we call what? Revaluation reserve. The reserve you create whenever you revalue your assets. The reserve you create whenever you do what? Revalue your assets above. So it basically goes to be part of the elements of capital under what we call what? Revaluation reserve. So you would have added here, let's say, for example, in this case, how much? 3 million. But we haven't been told. So maybe we'll be able to see it in another question where in this case, they have been able to revalue what? An asset. So the third statement in this case, it is the statement of financial position. 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 So statement of financial position. But before that, in this case, there's something I told you. So I don't know, we'll do a working. Is it working number 6 or 7? You can confirm. I told you there's an item we call what? Property, plant, and equipment. So in this case, you have to do a working for PPE. Property, plant, and equipment. Because for property, plant, and equipment, in this case, we also just present one figure in the statement of what? Of financial position. So in this case, if you look at the items we have as property, plant, and equipment, we have leasehold building, we have plant and equipment, we have what? Furniture and fittings. Furniture and fittings. So in this case, we'll have leasehold building. So leasehold building. We can do this working, leasehold building. So that is one of the items. Then in this case, we have plant and equipment. Plant and equipment. Plant and equipment. Then we have in this case, furniture and fittings. Furniture and fittings. Furniture and fittings. So you must have learned about something we call property, plant, and equipment movement schedule in your financial accounting. So that's what you are basically looking at, how the items of property, plant, and equipment are having to move. Then we just get one figure. We just get one figure. So we can get the totals. We can get the totals. So what you do here, you also start with the balances that you're having to be given as what? As maybe at the start of the year, or maybe the cost of the item. You can start with the cost of the item. Cost of the item. For example, in this case, for this whole building, we have 56,250. So it is 56,250. That is as per the TRIO balance. We have plant and this, it is 55 million. Then this last item is 35 million. 35 million. 35 million. So already in this case, you have what you are calling what accumulated depreciation that we've been given there. We have the accumulated depreciation that has been given there. It's still in the TRIO balance. This one is 18 million. So this one you less it. This one is 12.8 million, 12,800,000. This one is 9.6 million, so 9.6 million. But remember, we had actually done some computations for the depreciation for the year. Depreciation for the year. We had done computations for the depreciation for the year. Depreciation for the year. So computations for depreciation for the year. Depreciation for the year. So we had a working. Was it working number 3? So maybe you can be able to give me the depreciation on leasehold buildings was how much? The one we computed. That was depreciation for the year. In our working, there's a working we did. Was it working number 3 or something? It was 2250. So this one was 2250. So what about this one? Plant and equipment. Plant and equipment was how much? Plant and equipment, it was 6 million. It was 6 million. What about furniture and fittings? Furniture and fittings, it was how much? Furniture and fittings, it was how much? It was 1016. So 1016. 1016. But remember, on the items of plant and equipment, there was a plant which was disposed. These were the plant and equipment at the start of the year. But part of it ended up having to do what? Ended up having to be disposed. So in this case, you have plant and equipment disposed. Plant and equipment disposed. Equipment disposed. Plant and equipment disposed. In this case, you can actually put it at the net book value. The net book value of this item, it will likely be 20 million. You minus, in this case, 2.5 million. So you'll end up having to get a figure of 17.5 million. 17.5 million. So you reduce it at the net book value. Alternatively, you can reduce it at the cost, but when you come down here, you add back this depreciation. Sour. So you have to, in this case, take out that. Remember, they sold it. Bado haiko ndani ya hii, waliuza. Haiko ndani ya biashara by the end of the year, waliuza. You have to remove it at the net book value. So it is 17.5 million. Alternatively, you can remove it at cost up here. But once you get the totals, you need to add back this depreciation. And of course, that is the format you must have actually been taught in your financial accounting, that you add back any depreciation on disposed what items. Disposed what items. So you'll have to just take notes. You will basically take it out at the net book value. Alternatively, take it out at the cost, but once you get the totals, add back depreciation on disposed items. Add back depreciation on what? On disposed items, but you can be able to take it out at net book value. It was 20 million, and of course, the accumulated depreciation was actually how much? 2.5 million, as per note number 6. This one is in note number 6. So those are the items having to do what? Affect. Those are the items having to affect, in this case, what? The property, plant, and actually what? Equipment. So of course, we can be able to get the totals. We can be able to get the totals. Can be able to get the totals. We see how much. How much are you having to get here? 56, 250 minus 18 minus 2250. How much are you getting, Valerie? How much are you having to get? Jaribu kufinya calculator. Abdi, jaribu kufinya calculator. Jaribu kufinya calculator. Jaribu kufinya calculator. Karen Paul, jaribu kufinya calculator. 56 to 50 minus 18 minus 2250. I can see Duncan says, Valerie says 36. Duncan says 39. So tutafuata gani? Tutafuata gani? 36 ama 39? 36. Debbie says 36. Andrew says 36 million. So 36 million. What about this one? This column? 55 minus 12.8 minus 6 minus 17.5. 𝗂𝗂𝗀𝗂𝗀𝗲𝗂𝗂. So you people are saying 39. So the other is saying 39. So this one is 18. You kama mnaona kama ni 16. This one is 18 million. This one is 18. Sawa sawa. So the accumulated dependent is actually 18 million. So hope you are having to say that. So it should become to around 36. 36 should be correct. 36 should be correct, I think so. Yeah, should be correct. So this one is 18,700. 18,700. What about this last column for furniture and fittings? For furniture and fittings, it is how much? $24,384. So 24,384. So now you can get the total. You can get the total. There's an option. You can get the totals for each item. You put it here. Each item, you put it here. Each item, or you can get the totals of all of them. Then you just add and place a figure here. So how much are you having to get when you add the figures? 36, 18 plus 24. Because that is the figure for the PPE we are going to take into the what statement of financial position. It is 79,084. So 79,084. 79,084. So like that. So that is the total of what PPE that will end up having to take what in the statements of financial position. So hope you've been able to copy it. So just copy it very fast. I want us in this case, we look at the statement of financial position. Statement of financial position. Where are we adding back depreciation? So Andrew, did you get what I was having to say? So I said in this case, for this item, plant and equipment that was actually disposed, you less it off at net book value. Sawa. Net book value. What is the net book value of this item? It is 20 million minus 2.5 million, which in this case is how much? 17.5 million. Alternatively, I told you, you can less it at costs, which is 20. Sawa, you can less it at cost, which is 20. But I told you the figure you'll be able to get here, you need to come here and say add back depreciation on disposed items, which in this case will be 2.5 million. You'll get the same figure, 18.7 million. Sawa. So it is as simple as that. You have an option. You either add it back at what? You either less it at cost. Then when you come here, you'll add back depreciation on the disposed item, which is 2.5 million. Alternatively, you have an option. You end up having to do what? Less it at net book value, which is 17.5 million. You'll get this same figure. You'll get the same figure. So have you understood now? But now we won't add it here because I've already lessened it at what? At net book value. At net book value. So hope you're having to get it. Hope you're having to get it. So I can be able to see Hafsa is asking for a 5-minute break for prayer. 5-minute break for prayer. 5-minute break for prayer. So you can have the break. You can have the break. I'm going to give you the break. So you can take the break up to 7:05. Exactly at 7:05, you should be back. So I'm giving you the break at exactly 7:05. You should actually be back. We look at the statement of financial position. Yes, I think it will be okay if we continue. So I don't know whether we can proceed. Confirm. Can we proceed? Yes, I can see Abdi says yes. Yes, we can proceed. So we can now in this case look at the statement of financial position. So statement Salama Limited. Salama Limited. Statement of financial position. It is as at 31st of December 2022. So so we'll have in this case our shillings in thousands. So we can start with the non-current assets. We can start with the non-current assets. So non-current assets. So for non-current assets, automatically you're going to start with property, plant, and equipment. So property, plant, and equipment, which in this case, we've done the computation. We've done the computation in this case, and we've gotten a figure of, is it 79? 084. So you can look at any other item that can end up having to fit there as a non-current asset. So we have investment. Investment from the TO balance, it is 34,500. 34,500. So there's no any other item. So we have in this case current assets. Current assets. For the current assets, still you can be able to look at the TO balance on the debit side. Which item is having to tell us it is a current asset? It is a current asset. We have the inventory that we computed. We have accounts receivable, inventory that we computed in working number one. We have accounts receivable. I think those are the only items I'm happy to see. So unless there's another one. So inventory in working number one. Inventory in working number one. What was the figure? What was the figure? We have accounts receivable, which we have there in the TO balance. What was the figure for inventory in working number one that we computed? So accounts receivable, in this case, we're having to be told 35,700. So in working, it was 5950. Yes, 5950. 5950. So those are the only items that we have in this case regarding what the current and non-current assets. And therefore, we can do that. So there we can now look at the equity and liabilities. Equity and liabilities. So for equity and liabilities, this one, we've done it in the statement of changes in equity. And then in this case, we have ordinary share capital. We have also in this case, revaluation reserve. We have in this case, retained earnings. Retained earnings. Retained earnings. So for the ordinary share capital, what was the figure? What was the figure? It was coming to, is it 30 million? So it was 20 plus 10. It was 30 million. Revaluation reserve, it remains the same. There was no any revaluation, so we were remaining at 3,400. For retained earnings, it was coming to how much? Retained earnings, it was coming to, it was coming to a figure there. It was coming to 64,454. So 64,454. 64,454. Yes, 64,454. 64,454. Then we can go to, in this case now, the non-current liabilities. Non-current liabilities. Non-current liabilities. We have in this case the 6% debentures. 6% debentures, which in this case we are told the value is 10 million. So our shillings is actually in thousands. So the value is actually 10 million. We have in this case our 8% preference shares, redeemable preference shares, 8% redeemable preference shares. It is a value of 12 million. You can always look at the credit side of the TO balance if there's any other item of non-current liability that you can be able to identify. Also, you can be able to do what to include. You can also be able to include. So maybe I could be able to ask, which other item do you think we'll end up having to include here as a non-current liability? Apart from the 6% debentures, the 8% redeemable preference shares, which other item do you think we'll likely end up having to? Investment income. No, try to think. So there's an item I told you it will always be recognized also as what? As an non-current liability. Deferred tax. So it is deferred tax. Deferred tax. Remember what we said about deferred tax? And the figure for the deferred tax here is the one we would have computed at the end of the year. Ni ile tulifanya kwa working. Ilikuwa ingoja 40-50. The one we did in the working, 𝗖𝗂𝗂𝗿𝗀𝗃, it was coming to how much? 40-50. It was 40-50. 𝗖𝗂𝗂𝗿𝗀𝗃, it was 40-50 because you can see that what I'm having to tell somewhere here. I've just been saying 40-50 is at the end of the year. At the start of the year, it was 5,200. So the one in the trio balance, it is at the start. The one we computed, it is actually at the end. This one is one that goes as what? As an current liability. But the difference is either an increase or a decrease, which affects the expense in terms of what? The income tax. This one's the increase or decrease, we recognize it what? In the income statement. So that's what actually happens there. So the deferred tax will actually be part of what? The non-current what? Liabilities. The deferred tax at the end of the year, the deferred tax balance at the end of the year will actually be part of what? The non-current liabilities. Then we have in this case now what? The current liabilities. We have the current liabilities. We have the current liabilities. We have the current liabilities. So for the current liabilities, we have in this case a bank overdraft. I think you can be able to see it. There's a bank overdraft there of 1680. So bank overdrafts of 1680. We have in this case accounts payable. Accounts payable of 17,770. 17,770. So, and then in this case, we had what? We had the current tax. We had the current tax. The current tax in this case as per note number 5. So the current tax. Current tax as per note number 5, because you are told the corporation tax of 21.4 million is to be provided. It is actually what? To be provided. So it will basically go into the, they'll pay around in this case the coming year, maybe March or April, so like that. So that will be the current what? Tax. So in this case, it will be an amount of 21, it is how much? 21,400. 21,400. The reason why we say it is a liability is because if you're a very keen student of public finance and taxation, I don't know whether those who are doing PFT, you've already started taxation of companies. Under taxation of companies, you'll be told, of course, you get the corporate tax of 30%, in this case, for the profits that were made for the year. But now it is normally paid as what? As an installment. So it's normally paid as what? As an installment. So in this case, they'll end up having to start maybe the coming year like that. So they just did what? Provided for it. They just provided for it. So they never settled it. So it will actually be a liability. So sawa. So it will be 21.4 million. Then in this case, we have the accrued preference dividends. Accrued preference dividends. Ile dividends ya misi. Unakumbuka ile dividends ya misi. Ile ya misi. Ile dividends ya misi. So we did our computation for the 8% preference shares dividends, which we got how much? 960. Which we got 960. But in this case, what was settled was actually only 480. So it means there was a deficit of 480, which they didn't actually settle. They only settled the interim as per the trio balance. They settled the interim. But now in this case, there was a difference of what? 480, which was not actually settled. It is accrued. It is outstanding, which is actually how much? 480. So the accrued preference dividends. So the interest on this particular preference shares dividends is 960. What was paid was 480 as per the TRIO balance as the interim. But now what was accrued, which they didn't actually settle by the end of the year, was 480. So therefore, in this case, you can actually be able to less that one. You can actually be able to less that one and get 480. So in this case, it will be an amount of 480. It will be an amount of 480. 480. 480. I think those are the only items. You can try to add and see what we are getting there. Try to add. So try to add these ones. Try to add those ones. I can see you're saying 165, 234. 165, 234. So it should be, hope you're having to get the same figure. So 165, 234, so like that. So that's how you could have been able to come up with, in this case, what the statement of financial position, statement of financial position, statement of financial position. So I want us to open another question. So you can open, in this case, you can open, in this case, there's another question. This one was April 2023. So we can, in this case, open August 2023, question number 5. August 2023, question number 5. So we can start on that one and see how far we can be able to go. August 2023, question number 5. Once you are there, let me know. August 2023, question number 5. So confirm whether you are there, then I think we can start looking at it. We can start looking at it. So have you gotten it? August 2023, question number 5. So I can see Nixon says got it. I can see Karen Paul says yes. What about the rest? What about the rest? What about the rest? So confirm whether you've gotten it. Yes, we are there. So we can start. We can start. So the question says, the following TRIO balance relates to BD Limited as of 31st of December 2022. So property at cost, which includes building, so it is 400 million. It is total of 600. Plant at cost, motor vehicles at cost, office equipment at cost. All these are assets. Then we have, in this case, their accumulated depreciation as listed there. We have inventory at the start of the year, which is 138 million. Purchases at cost, distribution costs, admin expenses, revenue that was realized, trade receivables and payables. bank balance, the deferred tax. So that deferred tax is basically the balance at the start of the year. We have the current tax, which was actually provided for, is 32.4 million. We have in this case, which was current tax, which was actually settled, was 2.6 million. We have in this case bank interest, that is an expense. Then you have in this case ordinary share capital, share premium, retained profits. All these are items of what? Items of equity. Then you have the interim dividend, which was settled, was 10 million. Then you have a suspense account, which was 60 million. So note number 1. So during the year ended 31st of December 2022, BD Limited disposed of an item of plant for cash proceeds of 20 million, which were credited to the revenue account. No other accounting entry was made. The plant had a cost of 39,700,000 and had accumulated depreciation of 15.86 million. And again, or loss on disposal of plant should be included within the cost of what? Cost of sales. So this simply basically means we have to get the loss or profit on what? Disposal of this item of plant. So you have to get that one, the profit or loss on the profit or loss on disposal of this item, because you're having to be told that loss or on disposal or gain on disposal should be recognized as part of what? The cost of sales. It is the company's policy to provide for full year depreciation in the year of the asset purchase and none in the year of what? Disposal. So of course, automatically here, as per our previous question, this item of plant that was actually disposed will end up having to affect what? Our property, plant, and equipment movement schedule. So it means, as we'll be getting in this case, the items of PPE, this plant, we have to remove it. We have to remove it. You don't have to include it in what we've been given as per the TRIO balance there. So it will also be able to affect what? Our PPE. So we have to, in this case, do what? Consider that. Then depreciation, we've actually been given. This one basically will be part of the expenses. And of course, you can see in the last column of those depreciations, you've been told how in this case you'll end up having to account for what? For each and every depreciation. And this is what I was having to tell you. The examiner will be able to tell you whether in this case a particular expense will fall under admin, cost of sales, distribution, or in this case what? Maybe administration. So in this case, for example, the depreciation on buildings, you've been told this one will go to admin expenses, and you've been given the method. Plant, it will go to cost of sales. Motor vehicles, it will go to distribution expenses. Office equipment, it will go to be admin expenses. It has been discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting. 12 million of trade receivables are non-existent and need to be written off. Of this amount, 7 million relates to the year ended 31st of December 2022, with the balance relating to what? To the prior periods. So of this amount, 7 million relates to what? To the year ended 31st of December 2022. So in this case, you're having to be told that there was, in this case, what? These accounts receivable having to be reported as 12 million. Hiyo ni kama haiko, it is not there. It is not there. It is not there, but they have been able to recognize it as part of what? The revenue. As part of what? The revenue. So it means in this case, this is basically like a loss. It's like in this case, what? A loss. That in this case, you have to deal with, which was not actually in this case realized. So they're having to say of these amounts, 7 million relates to the year 31st December, the year we are accounting for. 2022 of these, 7 million is a hii mwaka. But the balance in this case relates to the prior years. So it means in this case, 5 million relates to the year 2021. That's what the statement means. Kuna hii pesa ilipotea. There was a fraud that occurred. And in this case, how much was actually lost? 12 million. So in this case, this 12 million here, it includes 7 million, which is for the current year we are having to account for. But the balance, which is 5 million, it is for the year 2021. So it means this amount will end up having to affect the retained earnings, which you've been given there for the year 2021. Lazima tutadeduct. Sababu wamegundua tu kwamba in this case there was that loss. There was that what loss, or that money that was not actually realized. So in this case, we have a retained earnings of, in the TO balance, you can be able to see a retained earnings of how much. I don't know whether they have been able to put the figure there. Is there a retained earnings? A retained earnings? We have in this case office equipment, inventory purchases. So we haven't been given the retained earnings at the start of the year. But in this case, ideally, that is how we'll end up having to account for it. It will actually affect the prior year. We have actually been given, it is 223,640. So it means the retained earnings at the start of this year, which were for the year 2021, we have to remove this 5 million because of this loss. 7 million is for the year 2020, which will affect the retained earnings for 2022. But 5 million will be for the prior years, which means is the retained earnings at the start of this year, which have been given in the trio balance as 223,640. So lazima tuta minus. So in this case, this item basically will affect us when we'll be looking at what? The statement of changes in equity. Remember, in this case, in the statement of changes in equity, being able to say you start with the balances at the start of the year. So this 223,640, which will be the balance at the start of the year, we have to effect this particular effect here. Because this loss is actually basically for the prior years, which is 2021 moving backwards. It has to affect what? These retained earnings at the start of the year. But of course, we've been able to discover them in the current year. We've been able to discover them in the current year. So this one should actually basically be part of what we should be able to account for. Then the existing debit balance on the current tax in the TO balance represents an under or over provision for previous year's tax. The provision for current tax for the year ended 31st of December 2022 of 52 million is required, together with a decrease to the deferred tax provision of how much? 3 million. So there's a new term there they have come up with. I'll be able to tell you how you'll be able to account for it. There's what we call under or over provision of, in this case, what? Current tax. So we'll see in this case how you'll end up having to account for it when you do the working there. Then inventory account on 31st of December revealed the value of inventory at cost was 85 million. So that is the closing inventory. Then on 30th of December 2022, the company directors invited the current shareholders to subscribe for rights issue on the basis of 1 new share of every 5 shares held at an exercise price of how much? 15 shillings. The come right price on the last day of trading was actually 20 shillings per share. The proceeds from the fully subscribed rights issue were credited to the suspense account. So that will end up having to affect the statement of changes in equity. Those were additional shares which were issued during the year, which basically in this case you have to account for them by having to add the newly acquired capital for the company on the item of what? Of ordinary share capital. So a rights issue, these are basically extra shares issued to the shareholders of the company in proportion to the number of shares they have. For example, in this case, you're having to be told for every 5 shares, you'll get 1. So we'll see in this case how many number of shares in terms of rights issue were issued, and if we multiply by the par value, how much was actually raised as extra capital, so that we can be able to add on it when we are coming up with what? The statement of changes in equity. So that is basically what in this case will likely end up having to happen with the note number 6. So you are required in this case to prepare a statement of profit or loss for the year ended 31st of December 2022, then statement of changes in equity for the year 31st of December 2022, then statement of financial position. So just the same items like in the previous question, statement of income, statement of changes in equity, then of course now in this case you come with statement of what? Financial position. So we can start looking at the workings so that in this case we get a direction as to how we'll be able to clobber these workings before we start looking at the final statements. We need to clobber these workings before we start looking at the statement of what? Income and those other statements. So we can start by having to look at those items. So the first item we'll be able to look at is actually disposal, the disposal account of the plants. So we can start with the working number 1. Working number 1. So disposal account for the plant, 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 disposal account for the plant. So what will we debit here? In the disposal account, what will we debit there? Valerie. What will we debit there in the disposal account? Cost of the plant, which in this case you are told was how much? Was actually 39,700. So our shillings are actually in thousands. So we are dealing with shillings in thousands, not cows, which are to be compulsorily vaccinated. So in this case, the cost was actually 39,700. Then the proceeds, cash proceeds on this sale was actually 20 million. Then the accumulated depreciation, so it had an accumulated depreciation of 15,860,000. Accumulated depreciation was 15,860,000. 15,860,000. So in this case, on this disposal, was it a gain or a loss? On this disposal, was it a gain or a loss? Was it a gain or loss? I can be able to see. Irene, you are giving us 28. I don't know where you're getting that 280,000. So 280,000. You're getting 280,000. I don't know where you're getting it. It was a loss, huh? It was a loss. So therefore, in this case, Irene, which figure is that? Which figure are you giving us there? So 39,700. So what is the loss? What is the loss? Irene, you don't pick the figure of plant in the. Don't pick the figure of plant in the trio balance. Remember that figure you've been given as plant in the trio balance. It is the cumulative all items in terms of plant. There can be 30 items, so all of them it was 280 million. But out of these 30, one of them was actually maybe disposed. So we are dealing with only that one that was disposed, which in this case we've been given the details what in note number 1. So you don't have to go back to the trio balance. Hope you're having to get the point there. So 3840. What have we been told about this 3840? It is the company's policy. So any gain or loss on disposal of plant should be included in what? In the cost of sales. You don't have to forget. You put there immediately. This one will go to the cost of sales. It will go to the cost of sales. So when you basically be computing the statement of what? Statement of expenses. We'll have to, in this case, consider this one as part of what? The cost of sales. Immediately, we'll have to consider it there. 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 Then it is the company's policy to provide for full year's depreciation in the year of the asset purchase and none in the year of what? Of disposal. Then, so during the year, BD Limited disposed of an item of plant for cash proceeds of 20 million, which were credited to the revenue account. So in this case, it means the revenue account was actually credited with how much? In this case, 20 million. Was actually credited with an amount of what? 20 million. So during the year, in this case, BD Limited disposed of an item of plant for cash proceeds of 20 million, which were credited on the revenue account. Which were credited on what? On the revenue account, on the revenue account, on the revenue account. So in this case, we'll end up having to deduct it or correct the figure of revenue account here by having to, in this case, do what? Minus, by having to minus, by having to minus, by having to minus. So in this case, the revenue account deduct the 20 million from the revenue account, from the revenue account. So it means in this case, when we'll be coming up with the statement of income, we'll have to remove this particular item here, or these amounts, which are basically on what? On the disposal of this particular item. So this particular item. So on this particular item. So we'll have to remove it there. We'll have to remove it there. Then we can go to depreciation. We can go to depreciation. Depreciation is actually our working number 2. Depreciation is our working number 2. So for depreciation, in this case, we've been told, so we'll start with buildings. So buildings. We can start with buildings. So buildings, in this case, we've been told 2.5% on straight line basis. What they mean by this, you basically take 2.5%, you multiply by the costs. So the cost is actually how much? The buildings is 400 million. So 400 million. So you should be able to get, in this case, depreciation for the year. Depreciation for the year. Depreciation for the year. So I can see Esther is asking, loss is not on debit. If the balancing figure was this side, it would have been a gain. Sawa. If the balancing figure was this side, it would have been a gain. But if it's a loss is normally this side. Sawa. Sawa, Esther. If the balancing figure would have been this side, it would have been a gain. But the balancing figure is this side, so it is a loss. It is a loss. So I think you're having to get, you have already given me the figure 10 million. 10 million, 10 million, 10 million. So that is, remember our figures are actually in thousands. Our figures are actually in thousands. Then we have plant. In this case, you are told 10% on a reducing balance. So you have in this case what? Plant, which is actually 10% on a reducing balance, So we can be able to compute for plant. Remember, plant ikona mambo. Plant ikona mambo, because part of these items ended up having to be disposed during the year. So they ended up having to be disposed during the year. So in this case, we need to be able to get the value of plant, which was actually in this case having to do what remain in the business. Remember, the method they are using is reducing balance. Reducing balance simply means, in this case, you have to get the cost, you minus the accumulated depreciation, before, in this case, you apply the percentage for what? You apply the percentage for depreciation. So you'll have to, in this case, get the cost, you minus the accumulated depreciation, then you apply the percentage. Before you apply this one, you have to get the balance that was already reduced. The balance that was actually already reduced. The balance that was actually already reduced. So therefore, in this case, for plant, in this case, if you're having to consider the cost, the cost is that figure Irene had actually given us from the TO balance, which is how much? 280 million. Yes, 280 million. But remember, out of these items of plant, there are some which have already, in this case, been disposed of. So we don't have to depreciate them, because you are told in note number 1, it is the company's policy to provide full year depreciation in the year of asset purchase and none in the year of sale. So this item was sold. So in the year it was sold, we don't have to include it as part of our depreciation. If they had told us it will be included, then there's no need for us to remove that item. But you have to remove it at cost, which was how much? 39,700. It was 39,700. 39,700. So the items remaining in terms of cost in the business is how much? Give me the figure there. But of course, in this case, you've been able to say you have to less the accumulated depreciation. Which now in this case, we'll have to consider what we've actually been given in the TO balance. On plant, it is 111, 160, 111, 160. What is the figure you're getting here? It is 240,300, sawa. 240,300, 240,300. So when you remove this item of plant which was sold, this is the cost of the items of plant which you are remaining with. Then, because it is a reducing balance, being able to say under reducing balance, you have to get the difference. You get the cost, you minus the accumulated depreciation for you to be able to apply the percentage of depreciation. So in this case, as per the TO balance, you can see on these items, easy items zote, the accumulated depreciation is how much? 111,160,000 so far. But now in this case, out of this accumulated, kuna ile tumetupilia mbali. It was how much? Ile tumetupilia mbali, it was how much? Ile tumetupilia mbali, it was how much? Try to think. Let's think together this thing. Ile ishatupiliwa mbali ni how much? It is 15,860. So that's what you're having to be told in note number 1. In this case, is how much? 15,860 on this item which had actually been sold. So 15,860. So overall, the accumulated depreciation of the items remaining is how much? Overall, the accumulated depreciation of the items remaining in the business is how much? Overall, it is how much? Zile items zinabaki kwa biashara ni ngapi? Accumulated ni ngapi? Valerie. What is the figure there? Get the difference. 95,300. 95,300. And therefore, it means in this case, by the end of the year, our accumulated depreciation on items of plant, it is 95,600. We get the difference between the cost and, of course, this one for us to apply the percentage of what? Depreciation. Therefore, in this case, we'll be able to take in this case what? 10% of this. 10% of, what are you getting as the figure here? 10% of 145,000. 145,000. And therefore, in this case, our depreciation on this case planned for this year is 14,500,000. Sawa. So hope in this case, you've been able to understand what we've been able to do there. Hope you've been able to understand what we've been able to do here. Augustus, je, umeshika ile kitu tumefanya hapo? Augustus, umeshika ile kitu tumefanya hapo? Augustus, umeshika ile kitu tumefanya hapo? Have you understood what we've been able to do there? Yes. You've understood. 15,860 umepataje? This one is in note number 1. Note number 1. These two figures are in note number 1. This one and this one is in note number 1. Alex Kirimi, have you seen it? It is in note number 1. And of course, hope you've been able to understand what I've been able to explain there. It is in note number 1. 15,860 is in note number 1. Sawa, so it is there. It is there. So that's basically how you'll be able to get, in this case, depreciation for the year for items of what? Of in this case, what? A bill plant. Then we have motor vehicles. Motor vehicles magari. So that is the third item. We have to compute the depreciation. So motor vehicles magari, in this case, 20% on straight line. So in this case, the EU tunachukua to 20% of the cost. The cost of these motor vehicles is how much? It is 70 million. 70 million. So this one comes to 14 million. Is it 14 million? I think 14 million. Hope it is correct. 14 million. Is it 14 million? Hope so. Then in this case, you have office equipment. So office equipment. Office equipment is how much? In this case, it is 12.5% on straight line still. 12.5%. We multiply by the cost. Straight line simply means you just apply on the cost, which in this case, it is office equipment is how much? 40 million. So multiply by 40 million. Multiply by 40 million. So what are you having to get when you multiply by 40 million? You get 5 million. So I think it is 5 million. Is it 5 million? So it is 5 million. Yes. So, but remember, in this case, you've been advised by the examiner, this one will be actually be the admin expense. Will be an admin expense. This one will actually be cost of sales. This one will actually be distribution. This one will actually be, in this case, be admin. So when you'll be coming up with the statement of expenses, you have to remember, you have to put them in their specific categories. Specific categories. So that's how basically you would have been able to deal with what? Depreciation. Then now in this case, we've been told in note number 3, we've actually been told, that it has been discovered that the former financial controller of BD Limited engaged in a fraudulent financial reporting. 12 million of trade receivables are non-existent and need to be written off. Of this amount, 7 million relates to the year ended 31st of December 2022. With the balance relating to what? To the prior periods. With the balance having to relate to what? To the prior periods. having to relate to what? To the prior periods. So in this case, of course, that is like a loss. Ni kama pesa ilipotea kwa biashara. It was a fraud. It was a fraud. And of course, in this case, it's like this money that had actually gotten what? Lost. The financial controller actually aliiba hii pesa, 12 million. So that's basically like an expense that in this case, this particular business actually incurred. Is an expense, like in this case, this particular business actually incurred. It is a loss. So a loss in this case ends up having to be like an expense for the business. Ends up having to be like in this case, what? An expense for the business. So in this case, you can be able to write, you can be able to write in this case, you can be able to write 7 million, in this case, you'll be able to, it will be written off as an admin expense, will be written off as an admin expense for year 2022. Then of course, 5 million will be written off from the retained profits, will be written off from the retained profits of the year, 2021. Retained profits of the year 2021. So the total here basically of the loss is actually 12 million, which is basically, this is the fraudulent loss. The fraudulent loss. This is basically how you'll be able to account for it. So you'll be able to write off the 7 million in the current year as an admin expense. So because this particular financial controller was actually administrator. Was an administrator. So it will come under admin expenses. He was like an administrator. So it will come under what? Admin expenses. So So salaries to the financial controller are basically admin expenses. Maybe in this case, would have deducted from his salaries. So it means in this case, that would be part of what the admin expenses, because it is arising from that particular direction. Then the 5 million has to be written off from the retained profits of the year 2021, which have been given the figure in the trio balance as 223,640. So you have to remember in this case, when be coming up with statement of expenses, this one will have to be included as admin expenses. This one will have to be deducted from the retained profits of the year 2021. So that's why we'll be able to account for that one. Then we can go to the next one. So the existing debit balance on the current tax in the trio balance represents an under provision or over provision for previous year's tax. A provision for the current tax for the year ended 31st of December of shillings 52 million is required, together with a decrease to the deferred tax provision of 3 million. A decrease to the deferred tax of what? 3 million. So this basically calls upon us to be able to account for what you're calling what? The income tax. We can be able to account for the income tax. We can account for the income tax. We can account for the income tax. So first of all, automatically, before we go to those olabulus of under and over provision, we've already been able to say, when you're talking about the current tax, when you're talking about the income tax, when you're talking about the income tax, the components here are basically current tax, and of course, in this case, what? Deferred tax. So of course, in this case, you're having to be told that, of course, the current tax is how much? The current tax they are going to provide for this year is going to be 52 million. So our shillings are actually in thousands. So you're having to be told in this case, it will actually be 52 million. So no compromise about that. So that's what we've actually been told. But in this case, we've been told that together with a decrease to the deferred tax provision of what? Of 3 million. So are we going to add or less? Let's see whether in this case, at least hii kitu imeanza kuingia. Are we going to add or less? Peter says less. What about Abdi? Abdi, you need to say something. Esther says we less. Esther says we less. Alex, do we add or do we less? Do we add or do we less? We less. Why do you think we less? Why do you think we less? Why do you think we less? This deferred tax, it is arising as what? As an expense or an income. It is arising as what? As an expense or an income. It is arising as what? It's an income. It's an income. At least you people are having to understand. So you are the most brilliant people I've met in the year 2025. You people are the most brilliant people I've met in the year 2025. You'll end up having to less because it was a decrease in the deferred tax. And of course, you say that decrease basically leads to what? An income. If it was an increase, it would have led to what? An expense. An expense. And therefore, we would have added. But because it is decreasing, it is an income. And therefore, in this case, it was of how much? 3 million. 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 So then in this case, we've actually been told the existing debit balance on the current tax in the TO balance. If you look at the TO balance, what are you seeing at the debit balance on the current tax? It is an amount of how much? If you look at the TO balance, there's a figure for current tax. You are seeing how much there? You are seeing how much there? You are seeing 2.6 million. 2.6 million, 2.6 million. So what I must be able to bring to your attention right now, and currently let this one actually end up having to stick. So get this particular concept here. So sometimes there can be, in this case, what we call what? Under or over provision of this tax, or over provision of this tax. Of course, you've actually been able to realize in most of the questions you're just having to be told there was a provision. There was a provision. So what happens here, as I told you, for example, in this case, in your public finance and taxation, you'll be told in this case what is normally paid is what? Is an installment tax that is normally dependent upon the previous year's what? Realized profits. So they add like 10%. So there's normally in this case just like an estimation. Like you can see they're having to say that the provision for the current tax for the current year will be 52 million. It means for the year 2022, wataanza kuilipia huku 2023. Wataanza kuilipia huku wapi? Huku mbele. And what normally happens in this case, they just estimate. Let's say, for example, in this case, for the year 2023, they'll add 10% on what was the profits. Then in this case, they allocate for 4 months. April, I think April, June, September, and December. So they might have ended up having to make what we call what? An under provision. An under provision, which in this case has to be settled in the coming year. Has to be settled what? In the coming year. So it means if there was an under provision on what they estimated as the current tax, haitaenda hivyo. Lazima tu watalipa. Lazima tu watalipa. So of course, in this case, if they have made a provision, they'll account for it in the year 2022. But when they get into 2023, when they start having to pay, they realize they pay to the taxman has basically charged them more than what they estimated, than what they provide. It's just a provision is an estimate. It's not the real figure. You might estimate, but of course, now in this case, what the taxman will end up having to charge you might end up having to be more, or it can be less. It can be more, or it can actually end up having to do what? To be less. So in this case, if it happens that the examiner has actually given you on the debit side a figure, of course, he can be able to tell you. If basically this particular current tax in the TO balance, the current tax figure in the TO balance is on the debit side, that basically means it was an under provision. It was an under provision, and therefore in this case, it will increase this what? Income tax expense. If it happens, this particular current tax figure is on the credit side. It is an over what? Over provision. It was what? An over provision. And therefore in this case, it will reduce the current tax expense. Sawa sawa. So in this case, in the TO balance, ukiona to examiner maker on the debit side, a figure of current, sometimes he can tell you. And of course, you can be able to see in this kind of a situation, amekwambia too, there was an under or over provision. He hasn't specifically told you whether in this case it is over or under, but I'm having to tell you, if there's a current tax figure on the TO balance on the debit side, that was an under provision. Wali provide, but ilikuwa kidogo, so they have to settle it. They have to do what? They have to settle it. And therefore, in this case, it means if it's an under provision, we have to pay it. It will be able to increase what? Our tax expense for the current year. So in this case, we'll end up having to add the under provision in the current tax under provision in the current tax, which was an amount of how much? 2.6 million. So that in this case, you can be able to get the income tax expense overall for the year. It was how much? You can be able to add and tell me the figure. Add and tell me the figure. Add and tell me the figure. It was an under provision because it is on the debit side. So it's on the debit side. If it was on the credit side, that figure was on the credit side in the TO balance, it would have been an over, and of course you would have been able to less here. So you're having to get how much? You're having to get how much? Alex, Valerie. So 46,400. 46,400. Is it 46,400? How comes you're getting 46,400? So Esther says 51,600. 51,600, 51,600, 51,600. So it is 51,600. 51,600, 51,600, 51,600, 51,600, 51,600. So maybe you can be able to write an NB after that. An NB after that. You can be able to write an NB after that. Just write an NB. Just write an NB. An under provision, 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 an under provision in the current tax, an under provision in the current tax, an under provision in the current tax, an under provision in the current tax will be added to the income tax expense. An under provision in the current tax will be added to the income tax expense. An under provision in the income tax, an under provision in the current tax, sorry, an under provision in the current tax will be added to the income tax expense. An under provision in the current tax will be added to the income tax expense. Full stop. Then you write another point. You can use our bulletin again. An over provision in the current tax, an over provision in the current tax, an over provision in the current tax, an over provision in the current tax will be deducted from the income tax expense, will be deducted from the income tax expense, will be deducted from the income tax expense, income tax expense, income tax expense. Then you can be able to write the under provision will be on the debit side of the TO balance. The under provision will be on the debit side of the TO balance, and the over provision will be on the credit side of the TO balance given. The under provision will be on the debit side of the TO balance, and the over provision will be on the credit side of the TO balance given. So that's how you identify them, because you can end up having to get confused through which one is under, which wasn't over. The examiner might not end up having to tell you. It'll be silent. So you have to identify them and, of course, add them as part of what the income tax expense. Sawa. So I think we can end there. So I can be able to see there's another class going to start. So just be able to try and actually comprehend those workings. I'll be able to discuss them again on Wednesday, on Wednesday or Thursday. I'll discuss them again on Thursday. So if you haven't understood this one, I'll also be able to repeat it briefly before, in this case, we continue. So we still have, like in this case, a number of workings to be able to do regarding this particular question here before we can actually be able to, maybe we still have the statement of expenses. I think that is the major one that is remaining. Then, of course, in this case also, we have that issue of rights issue, which also I'll be able to show you how you will deal with it whenever you are preparing what? The statement of changes in equity. Statement of changes in equity. So I don't know if there's any question up to that particular point in time, because I would like to end there. I can see there's another class that is to commence. Any question you might be having, any burning question you might be having, then take note. In this case, we said, so these are revision class. In this case, I said I'll be able to introduce. It is optional. You can join or you can fail to join. So it will be for theory. It will be happening every Wednesday from around 1:15 p.m. From around 1:15 p.m. Sawa. So it will start tomorrow. So you can make arrangements. If you can be able to attend, it will be for your betterment. So of course you'll be able to record, and of course you can be able to share on the LMS. So if you can't join, so you can always be able to follow it. It is not compulsory. So if you wish to join, you can join. So no problem. So you can join or you can fail to join. There's no problem, but we'll be able to do it. We'll do it 1:15 p.m. and of course I'll be able to share the link. We'll basically just be handling the theory part of financial reporting. I think that will likely be okay. So I think I've been able to pass the communication. Sawa sawa. So with that, I think we can end there. So let's catch up. Let's catch up tomorrow and of course again on Thursday. So you can have a good night.